Howdy, Jacob here. Today we're looking at Comfort Systems USA in the construction engineering industry. 19.5 billion market cap, 19.1 billion enterprise value. They provide mechanical and electrical installation, renovation, maintenance, repair, and replacement services for mechanical and electrical services industry in the United States. Founded in 1917, been around for quite some time here, and their growth of revenue has still been crazy impressive for a company that's been around for over a decade. 1.4 billion in revenue in 2014 up to 5.2 billion in 2023, with the last 2 years of year-over-year revenue growth of 35 and 26%. Their margins, however, are not super great, but improving. So 18% gross margin to 19% and 3% operating margin to 8%. So we are seeing bottom line improve just as much, if not more, than top line, which is great. They do pay a dividend, and it does not look to be a substantial amount in relation to their earnings per share, which is great. So their payout is not immense, meaning they have other forms of capital allocation to buy shares, reinvest, make acquisitions. And so return on invested capital historically improving and very high to where it's 22.5% in the most recent year. Very impressive. So no R&D, majority of their costs are cost of goods sold, so products to complete their services. 205 million cash on hand, 5 million short-term debt, 39 million long-term debt. More cash than that short-term and long-term debt, so definitely not concerned with that balance sheet. And production of free cash flow has grown just as much as their earnings per share, with CapEx going up along with it as they've been making acquisitions, but still improving free cash flow quite a bit. And majority of their form of capital allocation is going to be out of those acquisitions, with a little bit of payout, a 10%. Now it's even 5% or so of capital allocation going towards maybe dividends and share purchases and then debt reduction. So that's going to be enough to have me make some assumptions for revenue growth. So a lot of money being reinvested through acquisition, and that's been heavily growing their business. And so if they're able to keep that up, I mean, that's going to be probably looking at 8% growth. And for margins, they have been improving, which is awesome. They're becoming more efficient with the money coming in. Let's be a little bit optimistic here. 7 and 8%. I think that's pretty optimistic. Dividend of $1.40 pays out less than 10%. I think they're able to grow that quite a bit. Historically, over 10%. So maybe let's say 12% here, getting it to about $2.76 by the end of the 7-year period we're looking at. Share change, 1% for them is about 195 million. I don't see them buying that back, but really just offsetting stock-based compensation, let's say. Terminal PE, I mean, they've been around for quite some time here, so they likely have some power with their name, some of that goodwill power. And they're able to, make these acquisitions, hopefully, that, again, are efficient and keep being efficient, as we've seen from margins increasing. So maybe let's do 17 on the PE, price to free cash flow. And it's definitely seems expensive. And again, not terribly surprised based on that 41 price to earnings ratio. So it needs to fall quite a bit before you get the return that I'm looking for here, but fantastic company. No disrespect to them, just not at a price point that makes sense to me. Hope you enjoy the video of yours today. Thank you.